Hello and welcome. You're tuned into MF Corner. I'm Sonal Bhutra in the Mumbai studio. Today, with the Nifty at 25,000, we decode and answer if it is advisable to invest right now. If yes, what are the sectors that one should look for? And are large caps a safe haven currently, given the long ongoing rally in the broader market? The Nifty continues to trade at a premium to its long-term average of around 18 times PE, so should you still invest? To discuss this and more, we have with us today Sumit Agrawal, Senior Vice President, Equity at Bandhan AMC. Mr. Agrawal, good afternoon. Thank you so much for joining us today. And it is on a day when markets are making new highs. And, we have been talking about this, that calendar year 2025 could be the year of large caps. They've done well, but mid and small cap rally continues. So how do you look at the entire large cap space in this regard?
Yeah, thanks for having me on the show. Very fair point that while the initial expectation for CY25 was that large cap should actually do very well and probably some moderation in the mid and small caps, but that is clearly not played out. I see a lot of reasons behind this. Probably, the corrections which have been there in the broader market never really lasted beyond 3 to 4 days, especially in this calendar year. In fact, we have not seen subsequent 4 days, more than four days continuous fall in mid and small cap segments. Every time it falls, there is some follow buying, and actually it's a new rally. So yeah, to that extent, this rally has continued. But what it has done is it has equally made the large cap space much more attractive from a valuation point of view because earnings in this space continues to grow very well. And for some reasons, the premium to discount thing that we measure from vis-a-vis mid and small caps, I think that is clearly in favor of large caps. Although in the near term, momentum is working towards mid and small cap, but from an entry point of view, I think valuations look favorable for the large cap space, and therefore I think CY25 still holds a lot of promise for this segment to do well.
Okay, the way we have seen the moves, right? We think that 25 is over, but there's so much still left, right? But let's talk about the performance so far. What has been the large cap performance vis-a-vis small and mid cap, say, over the last 10 years? Can't consider the last 3-4 years because that has been very different.
Yeah, so see, the good part about statistics is that, you can look at the way you want to look at. So if you look at today, the 10-year compounding in Sensex or Nifty is about 12-13%. But the same compounding in a mid-cap index or a small-cap index is about 18%. So that is a clear differential of about 6%. And assume there is a new investor who is entering into the market right now, he can clearly get colored by the extra 6% CAGR that the mid and small cap is actually offering. But if you go ahead and visualize the same 10-year CAGR maybe 3 years ago, probably the mid, small, and large were all giving you a CAGR which is almost at the same levels. And perhaps if we look at in the COVID bottom, wherein, markets corrected heavily and mid-small corrected much more, at that point in time, large caps were appearing to be the clear winner and mid and small cap even on a 10-year basis, but lagging big time. So my advice is when you look at statistics, please do have some context of the history, how are near-term returns coloring the longer-term trajectory. And that is where a little bit of experience and a little bit of, time with the market actually helps.
Okay. So, what is your sense on Indian markets in general then? Because we are at the 25,000 mark. We've seen that rally, as you were pointing out, mid and small caps, much more. Do you think they're overvalued right now across most of the segments?
Not really. I would not say across most of the segments. But if you look at large caps or let's say BSE 100 for that example, not even Nifty, the top 100 companies, that index is currently trading at around 20%, 15 to 20% higher than its long run average. And I'm talking about a 10-year price to earning multiple. So I would say that is not expensive. 15-20% premium is still something which is easily digestible. But if you look at specifically mid-cap index, that is actually trading at almost a 50% premium versus its 10-year history at a forward P of somewhere around 30-32 times. And I think this is the level that we have not seen in the past. Same goes with small cap index as well, because that is the index also which is almost trading at about 40% on a price to earning basis, which is again at one of the historical highs. Last time when we saw this index trading at such level was just after the COVID recovery, somewhere in 2021. wherein earnings were actually very low in terms of projections, and therefore the PE was looking much elevated. So I think clearly, if you look at purely from a valuations perspective, large cap is still offering you the largest valuation comfort. And mid and small cap, probably because of being very concentrated, like mid cap concentrated between like top 100, between 100 and 150 stocks, probably it's quite expensive. In small caps, people can actually find some alpha, depends on the fund manager's skill set. What is the level of companies he is willing to explore? Is he willing to go down the market cap curve further? But on the whole, I think it's quite expensive given the strong rally that we have seen in the past 1.5 to 2 years.
I know you're absolutely right. So in that case, just wanted to follow up on this. You've explained the valuation differential that we are seeing in large caps versus small and mid caps, and the premium that these individual spaces are trading versus historical averages as well. That's very helpful. But in that case, are mid caps and small caps at a juncture where it is little tricky and a little scary to invest at certain levels? Is this time for caution in that space?
See, actually, depending on the mid and small cap, it's clearly an individual's investor's appetite. It depends on that. For example, if you look at the standard deviation of return, especially in the small caps and mid caps, that is much higher than the large cap segment as a whole. So the broader market tends to give you higher returns, but at the same time, they're equally volatile. So if an investor has a temperament of actually taking care of that volatility and he's okay with it, I think then it's okay. But otherwise, from a risk-adjusted return point of view, which is what I call, which like sometimes on a Sharpe ratio, or you divide the returns by standard deviation. I think that is where large caps have one of the least drawdowns. Historically, also, if you see, if markets correct, on an average, large caps have corrected about 14-15%, but the mid and small caps have actually given you drawdowns on an average of about 20%. And when it becomes slightly more deeper, it can go to as high as 40-50%. Thankfully, we are not in that zone currently, but an investor needs to keep in mind the drawdowns that can be expected in different asset classes or different segments of the market, and accordingly take a call between the large cap vis-a-vis the broader market exposure that he's having.
Okay, so let's talk about Bandhan's strategy in this case. What would your strategy be for choosing stocks in large cap funds right now?
Yeah, so we have been following a very time-tested BMV framework, which is called, business management and valuation, which focuses on buying good businesses run by good management, and available at an acceptable valuation, not a very cheap, perhaps not very expensive, but an acceptable risk reward. I think our focus is on giving a better risk-adjusted experience to the investor. We do not focus on chasing a lot of momentum or buying very expensive stocks in the fund, and I think that is a strategy which has helped us in the last 7 years or 8 years that I've been managing the fund. As of now, as we speak, we have been overweight on some of the defensive sectors, and that has actually helped the fund. So if you look at the characteristics of the fund, generally, in down markets, we tend to fall less, and in up markets, we equally capture the upsides. And that is exactly the science of risk-adjusted returns that I'm talking about. So very plain, vanilla, simple, time-tested philosophy, because that goes well with the steadiness of the large cap as a strategy that it provides.
Okay, all right. So this is what the strategy at Bandhan AMC is when it comes to large cap funds. Mr. Agrawal, it's a very interesting conversation, but we have to get into a quick commercial break. On the other side, we'll continue our discussion with Sumit Agrawal on large cap funds and what should the strategy be with large caps now. Stay tuned. Welcome back. You're still tuned into MF Corner. We have with us Sumit Agrawal from Bandhan AMC. We're discussing everything about large cap funds, whether it's a good time to put in more money here and what Bandhan AMC's strategy is when it comes to large cap investments. So Mr. Agrawal, let's talk about the sectors where you see an opportunity in the large cap space now, because you did say that it is cheaper than mid and small caps and there is some valuation comfort here. Do you like banking? Is it energy? Some of the spaces you can tell us, and why do you like them?
So see, large cap investing also offers you a very large options available on the sector side. So there are somewhere around 12 to 14 large sectors that you can actually pick up. Obviously, when you go to mid and small cap, the choices of sectors available expands, but I'm just restricting myself to large cap here. I think few themes that we like very much is, especially from a risk reward perspective, is financials, especially private sector banks. And this is a space which is actually clearly underperformed in the last 2 to 3 years. While profits of these entities have grown at a reasonable number, but stock prices have actually not grown as much, and therefore the PEs have actually contracted. So clearly, you see a lot of opportunity in financial space. In fact, we have a dedicated strategy for financial services in a fund platter. And when I say financials, I also talk a bit about why financials is not just restricted to the top 4, 5 banks or top 8, 10 companies. In fact, it's a much wider choice which is available today. You have things like insurance, asset management companies, capital markets, fintechs, and so many other things which you can actually invest in some bit or the another, even in a large cap fund, that actually can give you some flavor of longer term themes rather than the traditional time tested banking stocks which are there. So financials again is one of the major themes that we like. Followed by we have a preference for and especially in our fund itself, we have been slightly contrarian and overweight on information technology or IT as a sector. In fact, if you see, while the commentaries may not be as great, but results somehow have been better than the expectations, and with the outlook on the rate globally softening, I think the investor positioning in this sector is much lower than it ought to be. In fact, if I recollect correctly, IT weight in Nifty used to be somewhere around 12.5 to 14%. It went to as low as about 8-9% in the last 1 year or so, and it is gradually coming back. And I think this under positioning by investors in this sector will itself lead to this sector actually outperforming, in addition to obviously the underlying earnings. So I think that is a positioning that the fund has taken quite early and has also benefited from it. So tech is one such sector. Followed by we like consumption. This is also a sector which is underperformed in the past 2 years, specifically the rural aspect of the nation or the economy, because that is where the problem has been. And with things changing, we think consumption will also pick up, and therefore consumption again is a large weighted sector in the index, about 6-7% on the staple side, and remaining 6-7% on the discretionary side. So I think this as a pack again should do well. So these three sectors altogether, I think, is a chunk of where our bets are, followed by obviously auto and even Nifty Pharma, I would say, which is the healthcare sector, which again did very well during the COVID time, but after that somehow it has been subdued. So I think that also should do really well. So these 4 pockets is where our exposure is slightly on the higher side versus the benchmark.
Okay, that is very helpful. So that explains why you're looking at some of these themes, be it banking space or IT space as well, and the other names that you mentioned. But you know, Mr. Agrawal, we always come on this ongoing debate. What do you make of the active versus passive investing debate? What kind of mix should one see in the portfolio? Does one theme or one style work for everyone? What's your take here?
Yeah, so being a large cap fund manager, I have often faced this question, and my straight clear answer is that it's not active versus passive, but I think both of the strategies can coexist, and I can clearly give some examples about it. So in the past 10-15 years, you have had phases wherein markets tend to be very narrow, or it tends to be very broad. So in narrow markets, generally only a select number of stocks does well, especially on the large cap side. And that is the era wherein passives generally tend to do better. But when markets actually broaden, which is likely the current phase going on since last 2.5 years, actives generally tend to do well, because that is where the benefits of stock picking, and they can actually take some bets even in the mid and small cap up to 20%, which is allowed, and that is where actives actually generate alpha. So in fact, if you see for our fund itself, Bandhan Large Cap Fund, in the past 7 years, we have generated alpha versus passives or versus the index almost 5 years. Only 2 years we did not do well, which was 2018 and 2022, and these are again narrow market years basically. So that goes well with the thesis. And even if you see today, the BSE 100 is actually outperforming Nifty 50. So even within large caps, the not necessarily the top 50 which will do well. Even the next 50 among the large cap stocks are doing relatively much better. So I would say, and here again, as I started the conversation, the near 1 year returns or the near term returns do color your longer term returns as well. So please keep that thing in mind. As we speak, I think most of the funds on the active side would be outperforming the passives. But there might be time when passives actually come back if markets correct and market framework becomes slightly narrow, which incidentally is not appearing so far. But if that happens, perhaps passives can come back. But as I say, for an investor, it's good to have an intelligent mix of actives and passives, obviously in consultation with your advisor, because that is what will help you in the long run.
That makes sense. So, in that case, I just wanted to understand more from a macro setup perspective as well. How are you looking at the current macro setup, considering the global backdrop as well, a possibility of interest rate cut, we got the Fed meet outcome as well. What do you make of it?
Yeah, so I think from a macro stability point of view, I think India is very, very well placed because, amongst all the competing economies of the world, we are one of the fastest growing economy as of now. In fact, if you look at all the projections, the next 5 years will be the third largest economy. Already we have a large consumption base, and at the same time, on hard assets like infra and capex and the government push, that thing is continuing to do well. At the same time, our FX also remains quite steady with about $650 billion plus of FX reserves, very comfortable import cover, and that's why you're seeing a very stable currency as well. So from a macro standpoint of view, I don't think there is anything to worry as of now. In fact, with the latest outcomes of the Fed meeting and the commentary there around, it's quite clear that rates might soften earlier as it is anticipated to be, and which will actually help the inflation globally and more so countries like India. So, and sheer transition that we have made in the last 10, 15 years, is mind-boggling. So I would say macro setup remains quite benign for India, and as a result, it's not only going to benefit the broader market, but also the larger companies and therefore large caps as a strategy. I mean, you can't imagine a country doing well without the largest steel company doing well, or without the largest construction or largest cement company doing well, or the largest banks doing well. So I know broader market is in favor right now. It's a seasonal thing, but you can't do well with the larger guys not participating, and that's where my comfort for large caps, especially given the valuation differential also. That's where it stems from.
No, absolutely. And the helpful table that you have provided us with as well, India then and now, 1991 versus 2023, where forex reserves have grown to $600 billion versus $5.8 billion. We have share in the world GDP, which has risen to 3.1% versus 1.2%. Gross domestic product in purchasing power parity has grown to $11 trillion, which compares with $1.1 trillion. That's a 10 times growth that we've seen. And of course, the other statistics are there for you on the screen as well. So, Mr. Agrawal, we have around 3 minutes on the show. So last question before I let you go. The recent big event that we saw, and markets have waded through everything that has happened actually. First we had elections, now it was budget. What did you make of the budget and the changes that were announced? How would that impact, say, the growth prospects, the mutual fund industry going forward? What's your take?
Yeah, so I think budget was a welcome event, and there might some jitters around the capital gain taxation changes, but I think it's a good balance between capex, fiscal prudence, and welfareism. We have seen government had already spent a lot on capex in the earlier years, so probably this time around it was a bit moderate, but I think the same has been taken care by spending a lot of money to revive the consumption. And if you recollect my earlier talk about how rural consumption specifically has been weak in the country for the last 2-3 years, I think the steps regarding increasing employment or skill development, or maybe even in the new tax regime there is an incremental money that flows in the pockets of people. I think all that thing will add up to some amount of increase in consumption. It will it will help the activity levels to go up in the market. And in a way, when you are in a new, the same government has got re-elected and it's just the first year, in a way, it's a continuity which is prevailing. So that also gives a lot of comfort from a policy making point of view, and even business houses can take a view because you clearly have a continuity which is there. So therefore, I think stock specific or maybe sector specifics, I think consumption is a clear winner from the budget point of view. I think a lot of things have also been done in the earlier aspect on defense and capex as such, which is continuing very well. And because of that, you're seeing a lot of activity from the private guys also. My only hope is that even private sector capex should now pick up. So far, only government sector capex has been doing very well, but private sector was somehow on the back foot. My hope is that in the next 1-2 years, we should see that pick up, and therefore the entire journey of India moving from top 5 to top 3 economies in the world in the next 5 years. I think all these things are essential in that aspect to move on. All in all, it's good if we pay taxes because that is how governments generates revenue, and ultimately it is used for country's benefit. I'm personally quite happy if we have more clarity and more uniform rate of taxation across asset classes over a longer run, because then make decision making on investing, decision making on wealth creation, decision making on investments that you make becomes much more clearer. So I think all this is a thing in the right direction. So I would say I would say it's a good budget from that aspect.
All right, we take your point, and thank you so much for joining us with your insights and expert comments today, Mr. Agrawal. It was a pleasure speaking with you. With that, we'll take your leave on MF Corner today, but stay tuned for Closing Bell to take you through the last hour of trade.